Hey everybody, welcome. Thank you for being here. Another great Sunday day. Happy Father's Day to everyone, all the fathers joining us. We're here live every Sunday at 1 p.m. Eastern, 10 a.m. Pacific, and this is going to be an interesting live stream, I think, for everybody. We're going to be talking about, I don't know if you'd call it a conspiracy or a secret strategy behind the trade war that nobody is talking about. We talked a couple of weeks ago about the trade war, some of the stocks to protect your money, and we saw that protection in our 2019 stock market portfolio that actually, saved us quite a bit of that May drop in stocks. Now we're back. We're going to talk about the other perspective. What happens when we get a deal, or if we get a deal on the trade war. And I think there's this this secret strategy that I'm talking about is a very good reason for the idea that we're going to get a deal within the next few months, maybe in the next quarter, not necessarily this quarter, but definitely something that points to the fact that there might be something behind this that nobody is looking at. So we're going to get to those. We're going to get to the stocks that you want to be invested in ahead of that, and and how to make how to make a little bit of money on that. And we'll talk about also, of course, about the alternative theories in that. I see some people joining us. Thank you for being here. Again, these Sunday live streams are really, for my benefit just as much as for yours, because I love reaching out and talking with the community and having this back and forth. So we'll do what we usually do here. We'll have a couple of community shout outs, a couple of comments that we've gotten over the last week. I love to highlight some of these comments because I love the comments that come in on the videos. And like I said last week, it's not only for to answer your questions and everything, but it's for my benefit as well, because I get a lot of advice from your comments, a lot of ideas and insight, ideas for other videos, and ways to call out my own mistakes when I make them. So thank you for all the comments that you leave on the channels. Going to do a few comments, then we're going to highlight a few of the videos from last week and this week's coming up, and then we're going to talk about that how to invest in the trade war détente, right? A theory that could mean we get a deal pretty quickly, and how to be ready with some of those investment alternatives. So I see everybody joining in. Thank you for being here. Wow, we've got someone all the way from Bosnia. So hey, thank you for being here. Arizona. Greg's from California. Greg, longtime member of the community. I appreciate it. He's always has great ideas, great comments there. Brussels, Belgium, Portugal. Wow. I mean, it's always amazes me how how diverse and geographically diverse the community is. So thank you for being here again. We're going to leave room for Q&A out at the end of the live stream. So be ready for that. Love that engagement that we get. We're going to get right into it, though, because I want to get to those that secret strategy, that conspiracy behind the trade war that nobody's talking about, and I think it could really help position your portfolio over the next few months. So we're going to look at our first comment here, and this one was from Miguel. And Miguel was talking about some of the funds that we've been talking about lately, how to invest in ETFs and mutual funds and things like that. And this is kind of a comment or a question that I get often. Miguel was saying he likes the VNQ, the Vanguard Real Estate Fund that I talk about constantly because I love the fund. But did I think maybe the FERL is a better alternative? And the FERL is just another real estate investment trust. So REITs fund holds a lot of different REITs. So it's going to give you that same or close to the same real estate exposure without that direct investing in property. So he's talking about that, and he's also talking about the Tortoise MLP, the TPYP, as an alternative to the AMLP, which is the Alerian MLP fund, which holds MLP stocks or MLP partnerships. Talking about how do you pick different alternatives for ETFs, different that kind of thing. And this is something we talked about in ranking our best ETFs, which was actually last week's live stream. And you'll find in that I talked about one of your biggest ways to rank these is just by expense ratio, right? The vast majority of these ETFs are going to be very similar. They're going to track the same index, so they're basically going to give you pretty close to the same returns. So if you look at just that expense ratio, how much you pay every month, or well, how much is taken out of the fund to cover management expenses, or each year, is really the one of the biggest factors. But what happens when you find one with a very low expense ratio, but some other factors, And one of the things that I think a lot of people miss on these is, there's new funds being created all the time, right? New ETFs, and the problem with a lot of these is that they're so small, and the liquidity is so small that it kind of puts those funds at risk. Okay, and I mean, I don't want to pick on the FERL or this Tortoise fund, this TPYP, too much, because they could be good funds. They seem like good alternatives to these larger, the VNQ and the AMLP. But if you look at the assets under management of these, and this is really a big thing, very small, under $1 billion in assets, right? And what happens is when management goes to take its fees each year from the assets, then so annual costs of about 250,000 are pretty much the minimum to run a fund, right? Between management, accounting, regulatory costs, things like that. But usually, fund fees are 500,000 or more easily, right? Well, if you've only got a 0.2% expense ratio, then you need 250 million in assets for that fund. So market cap for that fund just to cover 500,000 expenses, right? So what happens when you get a lot of these funds, and you see this a lot more in hedge funds, really, but even in these ETFs, though, they'll start up, and for a year or two, they'll be in a growing period, right? They're trying to get to this minimum assets under management to make the fund viable or to make it profitable, right, for the company and for the managers. But a lot of funds don't reach that point. They go for a few years, and the fund never really grows, never really builds interest from investors, and so they just have to shut it down, right? So that makes for a very hard time for investors. You're forced to take those capital gains taxes. A lot of times you're forced to find another fund for that. So generally, I won't look at an ETF with under usually maybe $1 billion or so in assets under management or market capitalization, and that's just because like I said, the management, it needs to be large enough to where those management expenses or that expense ratio taken every year can cover the expenses, the management, and be profitable for the company, right? Or otherwise they're just going to shut it down. You also want to look at the liquidity and interest. A lot of these new funds or these kind of unique funds, we'll call them, might have maybe less than 100,000 shares traded daily, right? And it just becomes a real problem to manage these funds, to get a good spread when you're buying and selling and that kind of thing. So, I wouldn't necessarily say don't look at some of these smaller funds as alternatives, but just be aware that there are some factors that might not make the expense ratio the only thing you want to look at, right? I'd say for the VNQ and the AMLP funds, like these huge funds like this that cover a broad sector, maybe it's okay to pay an extra 1/10% in an expense ratio, in expenses per year, to get that size, to get that larger fund. But great question by Miguel. I appreciate him being a member of the community. He's had a few comments so far, and I appreciate it. I always appreciate the comments. Our next comment here is from Caleb, and he wants to look at my portfolio, which is another one that I get quite a bit. So I figured I'd take this opportunity to kind of answer it. Obviously I share our dividend stock challenge, our 2019 stock challenge portfolio on the channel, and I tracked that each month, doing very well, upwards about 20% return so far this year for that portfolio, and that's about 8 stocks, and then I think it's about 5 or 6 funds right now. So if you want to look at that, want to look at the dividend stocks that I'm investing in right now, then check that out. It's under the playlist section of the channel. It's a playlist, and then like the 2019 stock market challenge. You'll find every month's update, how we picked those stocks, the stocks in there, and the return to date on that. But I like I said before, I've got 5 different investing accounts, right? Different investing platforms. M1 Finance is the one we use for the dividend challenge. I use ETrade. It's the one I've had for the longest. I had ETrade while I was still in the Marine Corps when it was still Brown and Company. So I used to have ETrade because of the low cost. They started out as one of the low cost platforms. Now, there's still costs are still pretty low, but I still keep it around for some great research with Credit Suisse reports, Morningstar reports available in there. A lot of different research stuff with my ETrade account. So I have some stocks in there. I have a Merrill Lynch Bank of America account, which is another one I use for research. I've got an Ally Invest account, which is one that I use basically for that all-around financial account with banking and that kind of thing. So obviously I have other stocks in these accounts. So I wanted to share some of these and just give you kind of an idea of what I'm investing in. I want to be direct, entirely transparent. I'm not pitching stocks, any particular stocks on the channel, but I want you to invest more in broader strategies, right? But I do want to be transparent and show you what I'm investing in, just so you know that I'm not throwing out stock names on the channel, and I don't believe enough in them myself to invest in those as well. So to Caleb's question, I show here one of my E-Trade account. I have GE, General Electric. Believe a lot of haters on GE over the last couple of years, and rightly so. But I believe management's made those hard decisions, to turn the company around. Right now, if you look at the market cap of the stock, it is below the actual fair asset value of the of the companies. So a breakup value, if you will. So if someone were just to come in, buy GE and break off all the pieces, I believe you could get more for all the pieces than what the stock is being traded at. So great position to be in. I like GE. EGO, which is Eldorado Gold, talked about this a few live streams ago. It's a gold mining company in Canada. They've had a lot of problems with the Greek government over the last couple of years, so it's very depressed stock price. But just since I recommended it about 2 months ago, I think it's up 42% so far. I think there's more upside to go on this. On Greek elections coming out July 7th, going to be a new party in power, most likely, a more business-friendly party. So I own that. Lending Club I've owned for a few years, as well as investing on P2P on the P2P platform through the loans. Tiva, another one's had problems lately with the with the opioid crisis and different lawsuits. But again, I think a great position in that generics drug space and a good defendable position. Also on the XOP, which is an ETF of U.S. drillers and explorers. It's undeniable the energy revolution in the United States through the Permian Basin, through some of these other these other fracking plays, and I think the XOP is a great way to benefit from that long-term trend towards U.S. energy independence. The rest of some of the others here: ACC, DLR, EXR. VTR and WELL. Those are all REITs, right? One of my retirement accounts, one of my IRA accounts is almost entirely REITs, right? And we've talked about on the channel. I'm a huge believer in real estate. Have been since a commercial analyst intern in college. Have my own rental property portfolio that I manage. But these REITs are an excellent way to get exposure to real estate, huge cash flows without having that direct management, that hassle. So big believer in REITs, and I like the healthcare REITs. Obviously, healthcare is going to be one of those universal trends over the next 20, 30 years for as long as I'm going to be investing, certainly. So big into the healthcare REITs like the VTR and the WELL. The ACC is a kind of a college dorm or housing REITs, so they focus on residential living in college towns, that kind of thing. DLR is a digital REIT. EXR, I believe, is extra space storage, so storage REITs. Very low cost to manage these storage spaces, so that's good. NEM is Newmont, which is I think probably the largest gold miner in the world, if not one of the top three after a recent acquisition. Gold is I've said on the channel before, I don't normally like to invest directly in the commodities themselves, so like gold or silver, because they don't pay out anything until you sell them. So instead, I invest in the miners to get that diversification into the commodities, into gold. You still get a dividend return, and you can pick the best miners, the best of breed miners. So you're not just relying on gold price going up. You're relying on NEM or EGO being being the best at what they do. Besides this, the ones you see here, I also have some of the ones we've talked about over the last few weeks. Realty Income, which is ticker symbol O, is another REIT that I have. DCP, Sun, Sunico, and DCP are both MLPs that I invest in. Love the MLPs. Now, in MLPs, whereas I hold all my REITs in a retirement account, so I don't have to pay taxes each year on those investments or on those dividends. With MLPs, you want to hold them in a regular taxable account. And that's because a lot of the dividend you receive is going to be your return of investment. And what that means is, if you get a $2 dividend from an MLP each year, then maybe $1.60 of it, it's usually about 80%. So $1.60 of it would lower your cost basis in the shares, right? And this just means that when you do sell it, you're going to pay more in capital gains taxes because you reduced the amount that you paid on the shares. But you didn't have to pay taxes on those dividends that whole time, right? And the great thing about MLPs is if you put them in an estate, so you pass them on to your heirs, they never have to pay taxes on it. Okay, that's marked up to that current value, right? So you hold those in a taxable account. Great investments. I also own that Chimera investment management that we talked about a couple of weeks ago in a best high dividend ranking stocks portfolio. And beyond these individual stocks, I also have my P2P portfolio that I've shared on the channel here. So investing in P2P loans, which is kind of a fixed income hybrid there. I've got my direct real estate investments, so rental properties that I still manage, real estate crowdfunding, and then angel investing. I still do a lot of early stage business investing from my venture capital days that I worked with venture capital firms. And this is that's a really huge opportunity that I wish more investors were in, that kind of early stage pre-IPO investing, because that's really where the returns are. Okay, once a company gets to IPO, gets to the market, the VCs, the private investors, they've sucked all the return out of those stocks at that point. So now I do want you to understand, and we're going to get to today's topic real quick here. But I want you to understand, you don't need more than 10 or 15 individual stocks. I've got quite a few because I love doing the analysis. I do this 24/7, and so I have a little bit more time to pick individual stocks and do that kind of thing and share them here on the channel. But you don't need that many stocks. Pick 10 to 15 individual stock names, put 30 or 40% of your money in them. So you're limiting to the amount of analysis you do, the number of stocks you have to pick, and then put the rest of your money in these larger funds to get that broad market exposure, okay? It's going to limit the amount of time that you have to do in stocks, time for analysis and that kind of thing. It's going to give you that smoother return through those funds and a little bit of upside opportunity on those individual stocks. So those are the two comments that I wanted to point out this week. Again, I appreciate it. I appreciate all the comments I get. I try to answer every comment I receive and share the ones with you that are particularly helpful and insightful and stuff. Now I want to cover real quick last week's videos, this week's coming up videos before we get into that secret strategy behind the trade war that I think you can use to position your portfolio over the next few months here. So last week we had some passive income ideas videos, and very important. I love talking about investing. I say this all the time. I love talking about investing in stocks and traditional investments, but you will never get rich on these traditional investments. Okay, stocks, bonds, even P2P, right? Which upwards of 10% and a fairly safe investment, but 10%, it's a great savings It's a great savings rate, but to actually reach that point at which most people would consider themselves rich, you really need to be creating business. You really need to be creating a passive income, a steady income stream every month that is going to grow your money faster than that 8 to 12% annualized, right? So actually, Wednesday we talked about 18 passive income ideas. I ranked them from least passive to most passive. Told you, why I thought they were more passive than others, and how to get started. So excellent video to check out. And then I actually shared Friday's video was 3 passive income investments that really nobody is using. And these were ideas of buying residual assets, buying online assets to use as your passive income sources. And that one's actually been one of the most popular videos on the channel over just the last 3 days. So definitely check that out. Next week's videos, Monday. So tomorrow we've got another passive income idea, last in that 3 video series. These are some passive income ideas that you can start quickly, no money to put on them. So definitely an opportunity for anyone to get started with passive income. And then Wednesday we've got an interview with Carl Richards, which is the New York Times columnist. I don't know if how many of you follow him, but he's the first keynote speaker at a financial conference that I ever went to. So I've always really liked his work, and great personal finance author and columnist. He's going to be talking about how to manage money in your relationships and that kind of thing. So be on the lookout for those videos, and let me know what you think. Always looking for feedback on the videos. What do you want to see as far as videos on the channel? What do you like? What you don't like? Now let's get to that the topic today, and whether we're close to a deal on the trade war, whether it's going to be a while. This is really, besides the Fed rate easing, this is the number one factor driving stock prices right now. Okay, and there's really some pretty strong factors against a deal. Neither side is really feeling that economic pain yet, right? China's booking about 6%, a little bit over 6% annual growth on I think it's like $12 trillion of GDP. So pretty solid, strong economic growth there. The U.S. did about 3.1% in the fourth quarter, and I think first quarter was like 2.4% GDP growth. So not bad there either. So neither side is really feeling that pressure, to get a deal done. Both sides have dug in. There have been no conversations, no trade talks between the U.S. or China for almost a month now. And really the best case scenario we're looking at is June 20th. So in about 4 days here, we've got the G20 meeting in Japan. And both President Xi and President Trump are slated to be there, and there's supposed to be some kind of a meeting, right? Well, there have been talks for a month, so where are they at in negotiations, okay? Right now it's looking like the best case scenario is for them just to meet at the G20 on June 20th and have just a plan for meetings, right? So not even a deal, not even a structure for a deal, but just plan for more meetings, maybe a cool down in the rhetoric. So I think the markets are getting to where they are really going to be getting really worried about this. Most of the sell-off in May was due to the talks kind of derailing, but people are still hoping for a deal. No, we did talk about the stocks to protect from the trade war in the early part of March. And so you need to know what some of those stocks are. But there are also some strong reasons that we could get a deal in the next few months, right? After this G20, after some meetings, and including a theory, really. I don't know, like I said, I don't know if it's really a conspiracy, but definitely a secret strategy that I think is being used behind this trade war to do something else, and is going to push for a deal, right? So let's look at a few of those factors that are going to drive a deal, and I thought this would be a good opportunity to kind of walk through second quarter earnings, right? Second quarter earnings are coming up. Corporate America is going to be starting their earnings for the second quarter, and what we're seeing is the trade war is going to start affecting stocks in a major way. Okay, first quarter earnings actually fell 0.4% from a year earlier, and that was the first negative earnings growth for U.S. corporates since 2016. Right now, the second quarter, which started, like I said, starting to be reported in the next couple of weeks, is expected to be 2.1% down. So corporate earnings expected to be more than 2% down on a year-over-year basis. Granted, companies always almost beat this, right? You know, whatever your expectations are, or whatever the market expectations are, it's almost always beaten by the vast majority of companies. So it may not be negative, it may be close to negative, it might be in positive. If it is, though, that would be a technical earnings recession, right? Two negative quarters in a row is an earnings recession. And a very bad signal for stocks, right? Because earnings are ultimately the the value of stocks. So you can see in this chart, and I don't know if you can see both lines here. The light gray line is the is last quarter's reported earnings. So the first quarter reported earnings, and then the blue line is expectations for this quarter. And you can kind of see some of these almost universally lower this quarter, right? The almost throughout. In fact, I think all but one, the gray line, so first quarter earnings were better than what's expected this quarter, except for energy, that first one, negative 5.2% earnings in the first quarter, year-over-year basis, and this quarter they're expected to report 3%, right? Also, one of the few positive earnings expected this quarter. So what do we have? 1, 2, 3, 4, 5, 6 of the sectors here. So about half of the sectors are expected to report positive earnings. Okay, that's not a good sign, right? I mean, if 5 sectors are and the S&P on average are expected to report negative earnings, what does that tell you? That doesn't paint a good picture for unemployment, right? Because if companies aren't making money, then they're going to have to start laying off people, right? And really the economic growth, that unemployment has really been the linchpin to everything so far. Great information out by FactSet. Again, I use FactSet for a lot of my research. I mean, some of these, look at these, information technology. So it's technology sector. Earnings are supposed to be down 12% from a year ago. Materials. Earnings are expected to be down 7% from a year ago. So huge earnings, earnings disappointment or earnings losses coming up this or expected this quarter, second quarter. Okay. Another thing I wanted to point out, this other graph by FactSet, something that's really interesting actually. Revenue growth is expected to be about 4.1%, right? So sales growth at U.S. corporates expected to be 4.1% higher. On average. So what you see here in this chart, the light blue or turquoise line, I guess, is S&P companies, so companies in the S&P 500 with less than 50% of their sales outside the U.S. So the majority of their sales inside the U.S. Okay, that turquoise line, S&P 500 companies with most of their business in the U.S. The dark blue line here is all S&P 500 companies, right? So the entire S&P 500 index. The green line here then is S&P 500 companies with most of their sales outside the U.S., right? So companies with most of their business outside the U.S. And some really interesting things happening in this chart. I want to talk about them. So overall, that dark blue, those two dark blue bars, expecting about 4% revenue growth, 4% sales growth for S&P 500 companies in the second quarter. When they start reporting in a few weeks here. Negative earnings growth, though, 2.3% negative earnings growth over the last year. And this is really interesting because over the last decade, what we've seen with that sluggish GDP growth, that overall sluggish economic growth in the U.S. and even beyond the U.S., has been that sales growth has been really hard to come by, right? Wages aren't really growing so much, so consumers aren't spending a lot of their money. So sales growth has been really hard to come by. But earnings growth has been very good. Earnings growth has been excellent, almost double digits sometimes, because a lot of companies, they're using these super low interest rates to just borrow to the hilt, borrow tens and hundreds of billions and trillions of dollars in debt, and then using that cash to buy back shares. right? So what does this do? Obviously, this you take shares off of the market and your earnings per share goes up, right? So it's a lot of financial engineering has been happening over the last decade, trying to make this low revenue growth look better through earnings per share, right? So over the last 10 years, sales growth has been really weak, earnings growth has been good. Now, what are we seeing? We're seeing sales growth 4%, negative 2.3% earnings growth expected. What does that tell us? Well, our sales growth still isn't great, right? But now they're running out of those financial games, that financial shenanigans to make their earnings growth look good. We're also seeing higher costs for a lot of these companies. Even outside the trade war, a lot of the costs to corporates, input costs, so like commodity costs, wages are finally starting to creep higher. So a lot of these a lot of costs to run a business are going up, right? Well, that's decreasing earnings, right? So you've got you've got less buybacks for companies, you've got higher operational costs. So we're seeing, even though revenue growth is still decent, we're seeing lower earnings per share on the on the S&P 500 as a whole. So for corporate America as a whole, so that's not a good sign right there. But what we're also looking at though here, something really interesting that FactSet found out when they looked at companies with most of their business inside the U.S. versus most of their business outside the U.S. And this is really a kind of a proxy for that trade war. You can see here that those green bars. Companies with the majority of their business outside of the United States are expected to post a 1.2% decline in sales, right? So versus that 4% average for all S&P companies, 6% increase for companies with most of their business inside the U.S. Companies with business outside the U.S. expected to report more than 1% loss in sales and 9% decline in earnings per share. 9% decline. That's it's almost 5 times. So about 4 or 5 times what the average market is seeing, right? For companies with most of their business inside the U.S., expected to see 6% sales growth, so pretty decent there, and 1.4% earnings growth. So positive, still not great for earnings growth, but still positive. So yeah, you can look at the global economy isn't doing well. A lot of these trade tariffs and trade uncertainties are really starting to hit some of these stocks with overseas operations. Okay, and this is really bad news for some of the biggest names in the S&P 500, right? These are the 500 largest companies, the largest market cap, largest companies in the United States, and they've had to historically look elsewhere outside the U.S. for that growth. But now it's coming back to bite them, right? Apple books 58% of its sales abroad and is expected to see a 10% decline in earnings. For the second quarter, Apple is expected to post 10% decline in earnings from a year ago. Okay, of course, Apple is perennially beating their earnings estimates because they kind of manage those expectations. But yeah, 10%. Boeing books 55% overseas sales and is expected to see 45% earnings drop this quarter. Though of course a lot of that is also on its Max problems and other problems. But definitely some problems with the trade war starting to come through and see this. Now, so that's one factor, but I want to talk about that strategy that I think is being used behind this trade war, and probably the biggest reason that I think we could get a deal worked out, not necessarily in this third quarter, so not necessarily in the in the summer months, but definitely in that November-December area, right? The November-December timeframe, right? And this is because you have to consider if this is the Trump administration's actual plan for some of this, right? What is the number one far and beyond the main goal for the Trump administration right now? To get reelected next year, right? He wants to do change some of these trade policies for the U.S., work on the economy and immigration. A lot of these are talking points, and I have no doubt that there's people in the administration that care about these things, but it's undeniable that the Trump administration wants reelected in 2020. And what does he need to do that? He needs an economy. He needs economic growth, right? Right now, that is the linchpin to the Trump reelection strategy is economic growth. Okay, so well, we were going into 2018 last year, and the economy was clearly on its last legs. Okay, we were in a 10-year bull market. The business cycle turned in 2015, turned a little bit lower, but then quickly rebounded. So we were at least 4 or 5 years into, 3 to 5 years into the business cycle. And it wasn't going to last. The economy wasn't going to last through 2020. Okay, we would have seen an earnings recession. We probably would have seen a higher unemployment and a business cycle recession, probably later part of 2019 into 2020, which would have been about the worst outcome you could think of if you're trying to get reelected, right? Now, so 2018 we had the tax cuts, which was a huge stimulus. It's basically just, anytime you cut corporate taxes by 20%, 20+%, and cut consumer taxes as well, individual taxes, you're going to get a huge boost to the economy. Without those cuts, we would have easily seen that earnings recession beginning of this year, maybe even late last year. But that kind of sugar rush, kind of restarted the process. Well, that's kind of that wasn't going to last forever. Okay, that those tax cuts weren't going to be the stimulus that they thought they would be. So what did Trump need? What did the Trump administration need to prolong this economic expansion? Okay, what did they need to push it into 2020? Well, what happens in a trade war? What happens? Orders are generally, when you have a trade war or the expectation of one, orders are brought forward. Okay, obviously, if you're looking at tariffs coming on in the next few quarters and for uncertainty after that, you're going to order as much as you can now, get them in before the tariffs, right? And then everything in between, you're going to put it off, right? It's the uncertainty around your business model, the uncertainty around global trade, all of that. You're going to want to put it off until after that trade war stops. So generally, historically, what you get in a trade war is a big bump in economic growth before, okay, and we saw this in like the fourth quarter of last year was 3.1% economic growth, well above what we had seen in the other quarters, and then kind of stagnation for a few quarters. But then when the trade war gets resolved, when you get deals done and everything, and you get less in uncertainty and you release that tension, that volatility, then all those orders that were being piled up can come back. All that capital spending, that investment spending by corporates, by businesses, can be put on the table again, right? And you get a huge jolt to the economy, right? So, and that generally lasts, 2, maybe 3 quarters at the most, but 1 or 2 or 3 quarters, right? So, you have to consider when you've ruled everything else out, all this trade war, all the rhetoric back and forth, all the tweets, all the news releases on both sides, by China and the U.S., you have to follow the money, okay? Follow the re-election, right? So no, I'm not saying that it's all going to plan. I'm sure this has probably escalated a little bit further than what they would like to have seen. But I definitely think a trade deal in November, December, that fourth quarter is the most likely outcome. Okay, because that releases that tension, that gets those orders coming back, that jump starts the economy or gives it a little bit of a sugar rush anyway, enough that we still have economic growth through those 2020 elections, right? Which again is the ultimate goal here for the administration. So now the market is still going on the assumption that we get a deal, so both countries desperately need it. Trump desperately needs it for his reelection. So you've got the two theories, right? One is that this spins all out of control. What we talked about a few weeks ago, and how to position for that in things like utilities, real estate, consumer staples. These are all interest rate sensitive sectors, right? That are going to do well on lower rates, because if we don't get a trade deal, the Fed is definitely going to have to cut rates multiple times. Right now the market is expecting 2 or 3 rate cuts for the rest of this year. I don't know that they'll get it because the economy is still fairly strong. But if that trade deal doesn't come through, the economy is going to fall off a cliff, and the Fed will cut. So you're going to have utilities, real estate, and consumer staples are going to be excellent sectors to be positioned in. Now, if you're going with the other side of this, and what we've talked about, and why I think there will be a deal probably in the fourth quarter, is that you start to look at those other sectors, especially the sectors that have been beaten down the most during this trade war, and you start to look at tech, especially, okay, and especially semiconductors, okay, the whole restriction list on Huawei, and whether U.S. semiconductor companies like Broadcom and that can actually sell into the Chinese companies and into other companies. If we do get a trade deal, you're going to see a huge bounce in these semiconductor stocks, the entire tech space, of course. Also, autos, apparel. Apparel has been very hard hit by the trade war, just because a lot of clothes are made over there and shipped. So apparel has been hit. Chinese stocks. We've been talking a lot about Chinese stocks in the 2020 or in the 2019 dividend stock challenge, and why I think every investor needs exposure to some of these domestic Chinese companies. So that's going to be an opportunity. And then even in some of our domestic sectors, like domestic steel, U.S. steel has fallen by 75% since the start of the trade war, and that's just besides extra costs on a lot of their input products, then also the hit to autos and and some of these other sectors. So start looking at those, tech, autos, apparel, Chinese stocks, and even some of these other sectors and individual industries that have been particularly hard hit by this trade war. Now I want to open it up to Q&A, and I've seen a lot of great questions coming through. I want to answer every single one, so I'm going to scroll back up here and see if I can't catch a few of them that I've missed. But please go ahead and re-ask your question at the re-ask your question now, and I'll make sure I get to that. See a lot of people in here. Thank you again. Thank you for joining us every Sunday. This is it's my chance to just really engage and reach out and be a part of the community with you. So I do appreciate that. So what is it? I have time and opportunity to grow my wealth. Can you give me advice? Yeah. Okay. So Ben asks, I have 4 stocks right now, which are Yeti, SKWS, which I believe is Skyworks, which is has huge business in China, which is gonna have a problem if that trade deal isn't negotiated. But again, if we do get a deal, it's gonna be one of the best performers. EA and Tesla. Okay, so I mean I love that you're 19 and you're already investing in stocks. I do 4 stocks is not a portfolio. 4 stocks is gambling, really. What I want you to do, I want you to find some funds, some ETFs that give you that long-term broad market strategy. So we talk about the VNQ, Vanguard Real Estate Fund, a lot. We talk about the AMLP, which is the Alarian MLP fund, gives you that exposure to MLPs and the energy sector. Some of the sector funds that you can invest in, but you have to get that broader market exposure. And then pick 5 to 10 stocks. Now Yeti, I don't know what Yeti is. EA Interactive Arts. It seems like all your stocks. Tesla is kind of that hybrid between the tech and and auto. But it seems most of your stocks are in that tech space. So you're almost completely exposed to the tech space. You need to find some other stocks outside of tech. It doesn't have to be all the safety stocks like utilities and consumer staples and stuff. But find some stocks outside of the tech space that you can believe in and that you can invest in. But 19, you've got decades left to see it grow, and I think you'll do really well. So what else? What other questions do we have? How are you finding the best ones? That's a whole live stream right there. How do I find the best ones? Go to that 2019 Stock Market Challenge playlist, and I explain exactly how I pick dividend stocks and how I pick best of breed stocks and that kind of thing. So what else we have? Do you think Culp can turn it around for General Electric? Obviously, I do. I own shares of General Electric. Actually, I think when it came down a little bit more, just these last few months, I actually bought more. I've got I want to say about 40,000 in the stock right now. I think it's definitely a turnaround play, not something that you can expect to turn around this year. It's a long-term, 5-year turnaround story, but I think they will. They've got some great assets, and again, I think the breakup value of the stock is more than the stock, the market cap right now. So I think it's definitely a good position. What else? What other questions do we have? When you're asking a question, go ahead and put a question mark there so I know it's a question, so I can just scan through these and know what your questions are not. Lost long term. Okay. Oh, what companies will capture these jobs? Research companies list out of labor workforce bubble that grew. Yeah, I'm not quite sure. Drizzleby, I'm not quite sure what your question is there as far as out of labor workforce bubble. So go ahead and ask that again. Do you have a target price for AT&T? How do you think T-Mobile merger will affect it? Okay, Peter, thanks for the question. It's actually a question I get quite a bit. What I think of AT&T and the merger and everything. And I'm negative on AT&T. If you go back, I actually did a video about warning signs to a dividend cut, and that I used AT&T as an example. And undeniably a strong company, large company, going to be around for decades probably. But I just don't think the risk and reward is there for it. Okay, great dividend yield. I know a lot of people invest in AT&T for that dividend yield, but if you look at it, I mean, it's coming up on a very competitive time in 5G and everything. The capex spending is very high. They spent billions. They took on tens of billions of dollars in debt for this merger that they did, and mergers are historically tough to manage, especially one with companies this size. So I think the upside to the stock might be 8-10% at the most. Probably not even that. Maybe that's 7 or 8%. Most of it's probably going to be coming from the dividend. And what's the downside? Downside is that they can't manage this merger, that they don't do as well competitively in that 5G space or in some of these other spaces. They're combining two pretty different business models. So what happens if that debt gets unsustainable? So I just think the downside is very much a factor here, very much more at risk than the upside. And there are tons. There's 5,000 stocks out there you can invest in, and hundreds of them that are good companies will provide a much better risk reward trade-off than AT&T. So I do not invest in AT&T. There's definitely some positives on the stock, but I just don't think the risk reward is there on it, and because of that debt, because of the merger considerations, because of a lot of reasons. What else do we have? Good point. Okay, CBD stock videos. I haven't, Alex. I haven't done a lot of cannabis or marijuana stock videos. The problem with these is generally they're traded on hype. Okay, and no doubt. The industry is still developing. It's going to be a huge industry in the future. But the problem is when you get these new industries like this, and we saw this in electric vehicles, we're seeing this in marijuana, you see this in all the new industries when they come up, then they're traded largely on hype rather than that fundamental value, right? So unless you've got some crystal ball and you can say, okay, when is investor enthusiasm going to be max for these shares, and when is it going to fall off, then it becomes much more speculative in my opinion. So that's not to say that you can't look at some of these companies for the long term, see which companies are really the best, which ones are going to be around for that long term, and maybe try to pick up some shares when everything isn't in the news. Okay, when CBD and cannabis and marijuana isn't in the news, so maybe these stock prices come down off of that hype a little bit, take those long term positions. But yeah, in the short term, there's going to be growing pains, and it's going to be really hard to make that money in the industry, especially when the stock prices get inflated so much. So definitely, something you can think about for the long term, but yeah, I'd hold off for some of these. What else do we have? Okay. Uh, Canopy's clutch. Star is looking good. Tariffs being lifted on Mexico. What other questions do we have? Do bond ETFs do well in a lowered interest rate environment? Of course they do. That's basically the whole fundamental value behind bonds, right? Because they have that fixed interest rate, so they're largely driven by market rates. Okay, so as market rates go up, interest rates go up, then that fixed rate that you were getting on that old bond looks less attractive, right? If you're able to get 6% rates on new bonds because the interest rate is increasing, and you're only getting 4% from this bond, you're going to have to lower the price to be able to sell it in the market, right? So higher rates, lower bond prices, lower rates, higher bond prices, right? So any kind of economic weakness, if the Fed cuts rates, that's going to lower interest rates, and bond prices are going to go up. So great way to kind of protect your portfolio, protect a lot of your money when you see that happening. What else? India tariffs on the U.S. Thoughts? Sorry. I mean, it's a great question, but I haven't really been looking at the tariff situation with India. I don't think they would be. It would be hard to imagine another company or country starting some kind of a trade war with the U.S. Just because the obvious situation is that the U.S. right now, that the administration is very quick to fight back on trade, on tariffs, and to use tariffs as an economic tool, right or wrong. This administration is that's one of their first tools they go to. So it seems to me any company or any country trying to initiate that fight, it's obviously that the U.S. isn't gonna back down from a fight and stuff. So I haven't been following the India tariff situation, but I don't think that that would be something that they would want to get into. PGC, haven't really covered it a whole lot. Can't talk about that one. Thank you for sharing strategies. Knowledge of Tesla. Yeah, Tesla. I mean, I've seen a couple people ask about Tesla, and it's one we get quite a bit on the channel. And I understand the enthusiasm, and Musk is definitely an innovative thinker and a Renaissance man. But I just can't get behind Tesla. They perennially, they chronically miss production targets and earnings and stuff like that, just because Musk tends to overpromise and underdeliver. He promises the moon, and that's great for a forward-thinking person. He shoots for the moon. He doesn't always hit it. And the problem with Tesla is that investors and the investment community is starting to realize that they can't take these these tweets and these promises at face value. Okay. The second part is just fundamental, right? I mean, Tesla is trading at so many times more on a price to earnings multiple than all these other traditional car companies. And sure, Tesla's got a lot of brand cachet. It's got a lot of brand value. It's still, a very talked about car and a good quality car. But that's nothing that these other traditional car companies, Ford, GM, Toyota, haven't been doing for decades. And they're going to catch up. The technology is going to transfer. They're going to catch up. They're already making, electric vehicles and already doing very well. And what happens when so eventually that price to earnings multiple, that valuation multiple for Tesla is going to have to come down a little bit. The cars are going to be less and less important, less and less exclusive. When they're putting out millions of Teslas a year, that exclusivity is quite a bit less. And I think that idea is a lot of what the stock is trading on now. Not everybody can buy a Tesla, right? Just because production is so low and because they're so expensive, right? Well, when everybody has a Tesla, or a large portion of the population has a Tesla, then it ceases to be kind of the special thing that it is, right? So that valuation multiple is going to come down. And sure, earnings are going to be rising over that period. But if you get, or even as earnings rise, if you get that earnings valuation, that valuation multiple coming down, there's just no movement in the stock price. So you could get to a point where you're actually seeing them reaching their earnings expectations, they're reaching their production values, but the stock price still isn't going anywhere because that earnings multiple is coming down. And I think that's the problem you're going to have with Tesla. What else do we have? Well, this replay. Yep. These always go on as a regular video on the channel. It takes about 2 hours to process the video for YouTube, and then it goes on the channel, and I answer all the comments. So if I miss your question, or if you have another question after this, then go ahead and just put it in the comments in the video when it comes up on the channel. What else do we have? Do you buy tech mutual funds in your core portfolio to protect potential downside while trying to capture growth in the sector personally? That's okay, first of all, I don't buy any mutual funds. I hate mutual funds. The only mutual funds I've ever owned have been in a 401k, right? Because traditionally, a lot of 401k plans, you only have mutual funds available, right? By those plan providers. But outside of when you're forced to, never invest in a mutual fund, right? They're too expensive. The average expense ratio for a mutual fund is right around 1%, whereas it's about 0.3%, I think, for ETFs on average as the ETFs industry as a whole. So usually about twice as expensive to hold. You can always find an ETF for any mutual fund you want. You can always find an ETF that covers almost the exact same index, right? So with mutual funds, you're paying more for the exact same thing you can get in an exchange traded fund. The taxes are higher on a mutual fund, just because of how things are bought and sold and how things are marked on your on your account. You have to pay taxes every year on a mutual fund investment, whether you buy or sell or not. So you don't get that with an ETF, and they're not traded throughout the day. You never quite know what you're going to buy or sell a mutual fund for, because it doesn't have that liquidity trading throughout the day. So no, I don't buy mutual funds. Buy ETFs. But if your question was, do I buy tech ETFs in the core portfolio to protect from that? No, I don't. I've got a little bit in the XLK, which is the Spider Tech Fund, but not a whole lot. I generally get my tech investments from a lot of the other funds that I hold. Dividend funds, growth stock funds, things like that. Pros and cons, Greg. Pros and cons of ETFs versus CEFs. So ETFs are those open exchange traded funds you could trade just like stocks on any market. Closed-end funds are basically almost like private funds that you have to buy through a broker and that kind of thing. I don't do a whole lot with closed-end funds. I generally it's hard to see the benefit of a closed-end fund. They're generally higher expense ratios. They trade a little bit differently just because they are closed. And sometimes you don't get the transparency with a closed-end fund. You don't quite know what's in there, what the manager is going to pick. A lot of times the manager will have a little bit more leniency or leeway on what they can pick for the fund. So it's a little bit more uncertainty as far as what they're actually going to pick for it. So yeah, I generally just go with ETFs. I mean, there are reasons to go with closed-end funds, but I generally just stick with ETFs. JNUG. I don't know what that. I mean, I can look and see what JUNG is real quick for you there. Who asked that? Safet. But I can tell you now, if it's a company with less than maybe $1 billion market cap, I'm probably not even gonna say much on it. I generally don't look at JNUG. Okay, the Direxion Daily Junior Gold Miners. Okay. Daily Junior Gold Miners index both 3x shares. So this is an ETF, so a fund that invests in gold miners, but it's a leveraged fund, right? So 3x means they're trying to get three times the movement on those gold miners, right? So gold miners, good gold miners ETF is GDX, I believe is the general fund there, GDX. Yep, that's the Vectors Gold Miner. Gives you exposure to the gold miners universally. Now, what this is trying to do is trying to do 3 times that, right? And so what happens though in these is generally they're using a lot of derivatives, so they're not investing in the gold miners themselves. They're using derivatives and options and stuff like that to mimic this 3x leverage. Okay, so what happens when they have daily trades they have to do to maintain that 3x leverage? So what happens is these funds tend to be extremely expensive. Okay, any leveraged ETF is going to be much more expensive than your traditional ETF fund, right? So if you look on this JNUG, this Daily Junior Gold Miners Index Bull, 1.17% expense ratio, right? Which is huge. I mean, that is very expensive. If they can deliver this 3x value and the gold prices are rising and gold miners are doing well, then it might not be a factor, because obviously they're going to do, the fund is going to do very well. But as a whole, almost 1.2% expense ratio is far and above anything I would ever consider. We're usually talking about Vanguard funds with less than 0.1% expense ratio. So that's kind of one hit against it. The other thing though is these, if you've got a very good feel or a very good theory or thesis for why gold miners or gold or whatever the underlying is for these leveraged funds, why it's going to go up or down, then these can be a good investment. Okay, if you've got a very good theory or thesis why you think gold miners are going to do very well over the next month or two, then this might be a viable investment, right? But over the long term, these leveraged funds tend to underperform their benchmark, right? They don't. So this 3x shares isn't going to get 3x, over 3, 4, 6 months, right? It's going to underperform that actual 3 times leverage. And it's because you've got all that friction, those derivatives trading, the options trading that the manager has to do to maintain this leverage. You've got the expense ratio, which is huge. These are much more speculative trading instruments that you have to have a good direction on the underlying, whether it's up or down. But good question, because I know a lot of people love those leveraged funds there. So thank you for that. Roth IRA portfolio thoughts. Love the Roth. I think it's probably one of the most underappreciated investment tools of any, right? Everybody loves that IRA. So the individual retirement account, you get that immediate deduction on any money you put into your IRA each year, deduction off your taxes. Nobody likes the Roth, right? Because you don't get that deduction, but you look at the other side. Tax-free earnings all the way through. Any money you put in a Roth account, you're going to take out tax-free in retirement, right? And what that means is in an IRA, you don't pay taxes now, but you pay income taxes on anything you take out in the future. That means income taxes on the money you put in because you didn't already pay it, plus any earnings, any returns on that on those investments. So that's two sides of taxes there. On a Roth, you're paying the taxes now, and that sucks. But when you take that money out, no taxes on the returns ever. Those are tax-free returns on your money. So a great way to get a little bit more from your investments, and it's just smart. The old school of thought used to be, okay, well, you think about your taxes that you're paying now, the tax rate. Think about the tax rate in the future, probably with your crystal ball or something, and then whichever's lower, that's when you either take an IRA if you're paying higher taxes now, lower taxes in the future, or you do a Roth if you're paying low taxes now and higher taxes in the future. But who knows? Who knows where taxes are going to be in the future? It's a crapshoot. It's a crystal ball. So I say, no matter where you think your taxes are now or in the future or whenever, have both. Have an IRA, have a Roth IRA, because that's going to give you the flexibility in retirement to get some tax-free money, but you're still going to get some tax advantages right now with that deduction. Okay, you're limited to how much you can put into an IRA and a Roth together each year. Right now, I think it's about $6,000. What you can do is, though, you put all your money, and this is what I do. You put all your contributions, so that full $6,000 into an IRA, right? You get the deduction, that's fine. Every few years, you can roll some of that money over, and there's no limit to how much you roll over. It has nothing to do with your annual contribution limits, but you roll some of that over into a Roth IRA. Now you're gonna have to pay taxes on the money that you roll over, right? You're gonna have to pay income taxes. Your income tax is gonna be a little bit higher on that money. But again, you're going to get that tax-free money in retirement, and some great flexibility and some great benefits in retirement. So this is a way to max out your contributions each year, still have money in both an IRA and a Roth IRA. So great question. Love the Roth IRA. What do you think about trading options? I don't generally trade. It's a good question. Solve 236. I don't generally trade options. I have in the past. I was an options trader for a little bit, and I did a lot of straddles and straddles and some of those complex option strategies. It's like trading stocks. It's very hard to do without being full time, 10 hours a day in front of your computer, actually doing the trading, following the patterns, following that kind of thing. And the jury's out on whether you can actually make money on it. What I do use options for, though, is for hedging and safety and things like that. So I'll sell call options against some of the stocks that I own, called a covered call option strategy, right? And that gives me money for the stocks that I own, kind of limits my downside a little bit. If I feel that stock is going to run into some troubles, but I don't want to sell it necessarily, I can hedge market weakness with call options, that kind of thing. So I mostly just use options trading for longer term safety and hedging and cash even. Okay, so what else we have? Should keep buying or wait for the drop? Hoarding cash. Like I said, I think, and it's hard. You have to go back to your own goals, your own trading, your trading person or your investment personality, right? You have to know yourself as an investor. If you want a risk-free, don't worry about it approach, there's nothing wrong with that. Invest in like a core satellite strategy, like I talk about. Most of your money in funds, some individual stocks, long-term. Invest money every month. Don't worry about it. Don't worry about beating the market or anything. One of the best pieces of advice you can get, and this comes from a research by Dalbar that shows each year they research and study and show the average investor return for retail investors, and it's always like 3-4% average return, and that's stocks and bonds portfolio. Against long-term stock market portfolio, long-term stock market return of like 7 or 8%. So there's a disconnect there, and you got to think, okay, what is happening here? 4% stock market average returns for the average investor. It's because they're making all these bad trades. They're freaking out when stocks fall. They're trying to time the market. A lot of these things. And they're missing the market. 7-8% annual return is excellent. That will get to your financial goals. So if you are that stress-free, risk-tolerant, that investor that doesn't want to worry about it, then you don't have to be timing the market. You don't have to be jumping in and out or trying to protect it, and a lot of these things. There's nothing wrong with it though. So if you're not going to freak out when the stock market drops, you can time the market. You can pick individual stocks a little bit. And I would say that, maybe right now you want to stick with that protection strategy we talked about a few weeks ago in some of these interest rate sensitive stocks, so utilities, real estate, consumer staples, things like that. Because I think, this G20 meeting with Trump and Xi is going to be ultimately a letdown. It's going to be just an agreement for more talks. I think the stock market at best is going to be pretty much level. It's not going to rise too much, but the downside risks are definitely there. As we get a little bit further into the year and we start talking about, the economy more, the economy's kind of hurting from these, from this trade war effects and their earnings, then we're going to start seeing, more chance of Fed rate cuts, more chance of a trade deal, and, that's going to boost the stock market a little bit, at least in the next few quarters. So I definitely think that you can time this a little bit, maybe a little bit longer term timing, and protect your money now. Stay in cash a little bit. I have about 15% of my total wealth in cash right now, which is fairly large. But you got to understand, I mean, as a business owner, I've got most of my money, most of my net wealth in businesses anyway. Those pre-IPO private businesses as well as my own businesses. So a relatively small part of my money is actually in stocks. For most people, if you've got most of your money in stocks, then maybe you want a little bit more in bonds and real estate and cash to be able to withstand those ups and downs. So great question though. Heavily invested in real estate but have no debt. Should I avoid REITs? I don't know why you would avoid REITs. I mean, with real estate, I think every investor should have REITs, and unless you have a huge real estate portfolio that is very well diversified across all the property types. So you've got residential, you've got storage, you've got hotel, you've got industrial, office space, and you've got it all over the U.S. or wherever your geographic exposure is. You've got it very well diversified, and so we're talking 20 or 30 properties at least. If you don't have that kind of diversification, then you need REITs. Okay, you need REITs to give you that diversification as far as geographically and property type. Okay, you can't just be, you can't be a little medium or property mogul in your own city. Okay, even somebody with millions of dollars in New York real estate. What happens when New York real estate drops? Okay, your entire portfolio is there in New York. Okay, you need more diversification than that. So definitely diversify in REITs to get that property exposure and the geographic exposure. What else do we have? Strategy, consider things, Roth conversion. Yeah, definitely look at that Roth conversion strategy, because it's a way to get really the best of both worlds, right? You get your you max out your contribution in one fund, and you still get as much money as you want in the Roth as well. What about selling puts on the stocks you want to buy? I've used that as well. You can now, and I don't want to get too deep into options and puts and all that, but basically a put is you're selling someone else the right. If you're selling a put, you're selling someone else the right to buy it at a price, right? If you're buying a put, you're buying the option to sell it at a certain price, right? So what he's talking about here is you're selling puts, so you're selling someone else the right to buy that option, or to sell you the shares, right? So your obligation is going to be to buy those shares at that price. Well, you're collecting a premium, so you're collecting some money when you sell them that right, right? So what you can do is you can actually get into shares for a lower price, right? You're going to sell them a price, let's say GE is trading at about $10 right now, and we'll do a real world example here real quick. So we've got General Electric selling for about $10.23. We can go to options, and we can go to let's do. Oh, well, that's nice. I think. What is this? There we go. Options. See if options is working. There we go. Okay. So we're in the options screen on Yahoo Finance for General Electric, and let's use January 2020. So these are options expiring in next January 2020 on the 17th. Options also always expire on the third Friday of the month, right? So this is really when this contract to buy or sell a stock is going to be in effect, okay? January 17th. So we go to puts here, which again, like I said, is if you're buying a put, you buy the right, not the obligation. You don't have to do anything with this, but you're buying the right to sell that stock to someone else, right, for a certain price. On the other side of that, if you're selling it, then you're selling them the right, and you have the obligation if they want to exercise that right. So we've got GE here for $10. So I'm saying I will, I'll sell you the right to buy or to sell GE to me for $10. Okay. Now you're gonna have to pay me about $1 for that right. Okay. So I collect $1 now for this contract. In January, if this person decides they want to sell GE for $10, so maybe GE stock has gone below $10, and they want to get $10 for those shares, then they can sell those shares to me for $10. I have to buy those shares because I sold them that contract. But I got paid $1 for these, so my actual cost for these shares is going to be $9, right? Because I'm buying the stock from them, they're selling it to me for $10, but they paid me $1 to do it. So $9. So I'm basically $1.23 better right now. So if I wanted to, there's two things you can do this. You can speculate in these. So if you think, if you think GE is going to rise, you sell that option. They're not going to exercise this option if GE is over $10. Why would they sell their shares of GE to me for $10 if they can sell it in the market for $11 or $12, right? So you can speculate in this. If you think GE is going to rise, you sell these options. Or like he's talking about here, then, and I've lost where your name is. Who is that, Robert? Yeah. Okay. So what Robert is talking about here is, say I wanna invest in GE. I can do it here as well, and I can say, okay, well, I don't want to invest in GE where it is now at 1023. I want a little bit lower cost basis, right? So, I'm fine with investing in GE at $9 a share. Well, I can do this. I can sell them the right to those or those put options and collect that dollar. If they do sell the shares to me, then my cost basis is about $9. So, I'm happy. I've collected that money. If the shares go up, then I have that dollar and I don't have to do anything. I can buy the shares in the market if I want. But essentially, it's a way to get into a position, but collect some money up front. What else? What is the best option for short-term investments, like saving for a car, considering the bond ETF? Cecilia, I mean, it really depends on what your time is for buying that car for those short-term money needs. Even bonds. If you look at the bond ETFs in the 2008 sell-off, okay, even some of these higher risk bonds. So the HYZ, which is a high yield bond fund, some of these other bonds, which are supposed to be traditionally safe investments, they sold off as well. So there is always the possibility that you're going to lose even in these very safe bond funds. So like the BLV, like the AGG, which are both great bond funds, and I own both of them. But there's still the possibility that any 6-month time period, you're going to be down 4 or 5%. It probably won't be down much more than that, even if stocks sell off dramatically. Shouldn't be down more than 4 or 5%, but it's still going to be a loss. So if you're looking at money that you need in within 6 months, even within a year, most people would say, then investments aren't the way you want to go. You want to go into a savings account or a 1-year bond, something that is going to keep that in pretty much in cash. Okay, I know it sucks that you're only going to be getting maybe 0.5% or 2% at the most on your money. But it's safe, and that's what you need if you need that money within 6 months or a year. Now, anything beyond that, then yeah. I mean, if we're talking about money you need next year or in 2 years, then yeah, you can start thinking about safer bond funds. You can start thinking of even some of the safety ETFs like utilities. The utilities ETF it's going to be fairly stable over a couple of years. But great question though. And that's something that basically a lot of retirees need to be thinking about as far as protecting the money that they need to use within this year and the next year while still growing their money in the future. And that's something we talk about in our goals-based investing course, where using like a bucket strategy to protect the money that you need this year, but still getting that growth in the rest of your portfolio. What else do we have? So it looks like we're kind of coming to a slowdown in the question. Nordstrom share price is very low. What do you think of it? Should keep buying, collecting a dividend. Okay, so these retailers, especially the department store retailers, is a tough space right now. Has been for the last few years, but even more so. And I don't see any reprieve. Okay, I mean, obviously all these department stores and even the smaller retailers are looking at e-commerce, expanding their e-commerce sales, percentage of sales, but they're still by and large that traditional brick and mortar retailers, which is a tough space to be in. It's that trend towards e-commerce, Amazon, digital, digital commerce, digital retail is undeniable. It's unstoppable, and I think at best you get. Obviously, okay, yeah, around earnings for some of these stocks, especially Nordstrom, I think they had a couple of good earnings calls over the last few. You're going to see huge bump ups in these stocks, 20%, 10% in a day, because, they seem to be like they're addressing these. But over the long term, I mean, even in the best case scenario, I think the long term is going to be kind of flat or rocky or down for a lot of these, because, you can put Band-Aids on it, but this wound is open, and it's going to be open for a long time. And I don't see any of the traditional realtors or retailers are really changing their business model so much that they can get out from under this death by Amazon kind of idea. So, I mean, I shop at Nordstrom. It's a great department store. A lot of these are, but I don't think that I would invest in them. It's very risky. If you want, you might be able to, if you think retail is going to turn around, you can go for some of these funds. The retail funds might be a little bit better option, maybe a more diversified option, but it's gonna be tough for years for them until they figure out their business model. Alibaba, I would, I haven't seen where Alibaba is right now, but I'm huge on Chinese stocks. You know that. Anyone in the community knows that. I think this is a once in a lifetime, once in a generation opportunity with the sell-off in Chinese stocks over these last few months. Pick them up because they're going to be a big part of the economy, the global economy in the years to come. Alibaba, one of the biggest. Alibaba is the Amazon of the rest of the world. Anywhere outside the U.S. is Alibaba. So definitely a long-term pick that you want to look at, whether it's a buy right now or not. I mean, I think you can make an investment now and then kind of leg into it over the next year or so. So this is where every week I tell myself, okay, going to be a quick one. I just want to connect with everybody in the community and trade back and forth, and it's always fun. I tell myself it's going to be a short one, and it ends up being an hour and 20 minutes. So I think I'm gonna cut it off here. I appreciate everybody for being here. Thank you. This is the highlight of my week a lot of times. Back and forth here and sharing these with you. So look for those videos coming up this week. Another passive income one coming up Monday, and then some great interviews we've got for the rest of the week. Anytime you have a comment, you have feedback, good or bad, I always want to hear your feedback in the comments to the videos. So let me know what you want to see. Let me know what you want in those. So other than that, see you this week through the videos, and next Sunday for our live stream. Thank you.